So thank you for joining. And I did have the little bit of clickbait this afternoon for you guys to join, but more so just to get everyone involved and excited about how all of this works when you're investing in a real estate syndication. And of course, I'm going to give you the scenario, the grand scenario, and how all of this is supposed to work. So, what happens when you invest $50,000 each year in real estate syndication? Now, as we start um, with all of our meetups, we have this disclaimer, and the disclaimer is just to protect you and me, right? Because what we're talking about is if you're investing $50,000 in anything, I would definitely want you to consult your financial professional before making any financial decisions, right? Because Lee Johnson and Value Investment Partners, we're just personal investors who are sharing our opinion, right? We are not your financial advisor, your attorney, or your accountant, right? One of the things that I want you to be aware of is that we do have a code of ethics here, right? And because we're just relaying to you our personal experience, right? We're not receiving any compensation today for making any recommendations to anyone. One of the things that I will share with you is I'm a very big fan of a platform called peerstreet.com, and we'll put that into the text, into the chat. But peerstreet.com is one of the vehicles that I use to accelerate the returns that I'm generating on my cash flows. So we'll get into that in just a little bit, but we just wanted to make sure that we touch on our code of ethics so that you have a full understanding that, guess what, guys, we're giving this away to the world because we believe it's valuable information that if it's taken in its context can actually change the lives of people who it touches. So that's our mission in life. So let's get started. And this can be an interactive session. This is not, we have to wait all the way to the end for you to hear what we're talking about. If you have a question, I'm happy to stop the presentation, address your question, and we can move on from there. Does that make sense? Can I get a thumbs up on that? All right, all right. So year-to-year projections are what we're going to talk about, right? The very first investment that I've had into a syndication was in, I would think right now, and I have to go back and look into the system, but it probably was around 2017, December 2017, going into 2018. I made my first investment into a real estate syndication, and that was with a group called Mission Bay Capital. We're still working with Mission Bay Capital. As a matter of fact, that property is located on our website. It's in the state of Georgia. The name of that property is Abbey Lake. The great news that I have to report to you guys on Abbey Lake is that it is now up for sale, right? So that property was purchased for, give or take, 9-10 million dollars. It's actually under contract. The PSA has been signed, and that property is about to close in middle of December. It's going to be closed. The contract price right now is for $14.8 million. So that property has performed extremely, extremely well. That's a scenario that you have with this, right? But it gives you an idea that this is pretty real, right? And it works. It just really works. We'll summarize everything that we spoke about towards the end. And as you guys very well know, if you want to share this presentation with others, all you have to do is go to our YouTube channel. And if you want the presentation, we upload the presentation to our private Facebook channel, right, called Value Investment Partners Loudon REI Connect. So if you want the presentation afterwards, it'll be uploaded there as well. But we also have probably every single presentation that we've completed from the very beginning. So if you want more, you can go and check that out all on your own. All right, let's move on. Investing in real estate syndications, right? Syndications are crowdfunding, or you might say group investing, right? Now, you might ask the question, well, crowdfunding, what is that? Group investing, what is that? Joint venture, what is that? Right? And all investors come in and invest in the acquisition of real estate. But I don't want to confuse you to think that syndications only work around real estate, right? Syndications actually work in a number of different investment vehicles. The reason why we're targeting the reason why we're targeting real estate syndications is that's what we do, right? But I have seen syndications come together around self-storage. I've seen real estate syndication come together around I've seen real estate syndications come together around car washes, right? But the difference between a joint venture is a joint venture is probably going to be set up as one LLC, right? Where everyone has well percentage portions to their investment inside of the JV. At that point in time, you don't have to go and get an SEC attorney to create something called the private placement memorandum, right? Which basically is an SEC document that has to be filed at the end of the raise that basically lays out all of the details, right? So syndications are a little bit different from crowdfunding, which is a little bit different from group investing, which is a little bit different from JVs, right? However, what we can say to you is that in a typical instance, right, when you're working with a real estate syndication, the majority of them will have a minimum buy-in of $50,000, right? I'm now seeing others because the market is changing a little bit that have minimums of 75 or $100,000, but there are things that are going to change. You might ask, well, why is a person looking to invest in a real estate syndication? And I'll start by saying that people are invested in syndications. I am invested in real estate syndications is because I I have gone to the Bank of America's website and I have seen the interest that they are giving you on a savings account. You will be very lucky to have a savings rate of 0.05%. You would be lucky to have a rate that is there. And that was at $100,000 inside of the savings account, right? I also saw that if you have, I think up to $999, they are offering 0.01% on a savings account, right? Here with a real estate syndication, I'm looking for a preferred return. And a preferred return is something that we advocate for all of our investors, right? Because a preferred return says that the LP side of a syndication, right? So LP stands for limited partner, right? And on the other side, the team that puts together the deal, finds the deal, finances the deal, works with investors, that's called the GP side or general partnership, right? There should be an interest in the people who are bringing the money into the deal. They should get paid before the GP team gets paid. This is why I never invest in a deal unless it has a preferred return. And right now, preferred returns are between 6 and 8%, right? You might be asking the question because there are other investment vehicles right now where treasuries are trending, et cetera. The arbitrage between treasuries and that 6% are getting closer and closer and closer. But you might ask the question of, well, why a syndication, Lee, right? Why a syndication, right? And the reason why I would say that you want to go with a syndication, The reason why you want to go with a syndication is because with a syndication, you also have the opportunity to participate in the upside of the deal, right? So that $50,000 that you are investing, if you were to go into a treasury, they're just going to give you debt interest payments, right? However, when you're investing in a real estate syndication, that equity multiple that you have right here can be multiplied. So that 50,000 can result in a return of 75,000, or it can go up to doubling this money over time, right? The higher the equity multiple that you can get, the better off it should be. But all of these things need the balance, right? The IRR is something that you're looking for because the IRR is the return over a number of years. You have the AAR, right? And then you have the IRR, and you should look at those terms as well. We like to look at deals that are around 18%, but understanding that the market has shifted just a little bit, right? You might find that they are going to be offering IRRs probably north of 15%. And definitely you're looking for your average cash on cash returns, right? Now, when it comes to investing $50,000, you may be looking at me and say, Lee, well, I don't have $50,000, right? And that's where I say you have to get creative, right? Because if you don't have $50,000 in personal funds that you can invest into a real estate syndication, you may be able to invest in a syndication using something called the self-directed IRA, right? SDIRA. It also can go by the term of an EQRP, which is a qualified retirement plan, where you have control over the assets that the retirement account is going to be invested in, right? One of the other things that I have, like if you live in, I believe it's Arizona, I have one investor in Arizona. They don't do LLCs in Arizona or something like that for this type of investment. So you would then invest via a trust. You could also, if you have a working capital account or a business account and you don't want that money sitting there, you can also invest that money using a business entity. We've done that with our business. You know, we had some resources that were just lying around inside of the account, not really gaining any type of interest, right? Not gaining any type of interest by being in those bank accounts. And what we were allowed to do is we were allowed to put that money to work. And that's something that I'm going to strongly suggest for you as well. One of the things that you may not know about, but life insurance in particular, whole life insurance policies have something called a cash value, right? And that cash value can be used so that you can invest that cash value. And one of the reasons why I am a particular fan of using insurance policies for investing is because it's one of the only vehicles that I have found personally where you can actually make an investment or money be working for you in two different places, right? So of course, the insurance policy has a death benefit, but it also has a cash value component, right? And that cash value component can be, a loan can be taken across from that. So the loan is going to be, let's say, at 4%, right? You then take that loan from your insurance policy, you invest it in a syndication that's giving you 6 or 7%. The arbitrage, that 3% between the 7 that you got from the real estate syndication and what you're paying back for your cash value loan, that's money that becomes yours. You can put that money to invest in another vehicle at the same time. That's why I'm telling you guys about Peer Street, which I love, is because you could actually have money working for you in two places at the same time. All right, any questions before we get started?
This is Christian.
Hey, Christian, go ahead.
Can you explain what Peer Street is one more time for me, please?
Peer Street is investing platform, right? Peer Street is an investing platform where they do crowdfunding, right? So what Peer Street will do is Peer Street will take a whole bunch of investors and give them a first trust position on a property, right? So
Okay.
what happens is these people are flippers. They need a loan, right? They don't have the money. They need a loan. It's very risky to invest in a property if you don't have first trust position. What I like about Peer Street is that they allow you to get into first trust position with as low as I think it's $1,000 minimum investment, but that minimum, that $1,000 can be pooled up with, let's say, 99 other people, which makes out $100,000 loan, and that loan has first trust position. And the reason why you want to have first trust position is because if you had to foreclose on that property, or if Peer Street has to foreclose on that property, they don't have to worry about someone else being in a higher tier position than themselves, right? They
Okay.
be in first trust position and they can foreclose on that property and take it back, and then they'll go and sell it. Does that work for you?
Yes, sir. And this is a website, correct?
Yeah, it's a website, and I'll share a link with you so that you can get access to it
Okay, thank you.
towards the end of the presentation. But thank you, great question. All right, so let's talk about it, right? And these are all scenarios that we're baking, right? So there's an investment, right? That investment has 350 units and it's located in Texas. Don't get bent out of shape about, oh, I don't want to invest in Texas. Texas can be exchanged for Florida, North Carolina, Virginia, anywhere in the United States. To be honest with you, you could invest anywhere. What we're going to use for this scenario, because when we first started this, the average was 8%, right? However, we used to be able to knock into deals at 9, 10% preferred return. You actually can get into deals that are offering a preferred return higher than 8, right? But in particular, we don't invest in those because at 8%, or well, at 9% or 10%, you're only going to get cash flows. You're not going to participate on the back end when the property is sold because you took that higher return, right? So that's a portion of it. So 8% on $50,000 generates $4,000 per year. Now, what I like about this is, guess what? That $4,000 is going to be monies that you didn't have to use these hands for, right? That $4,000 is going to be deposited into your account on a monthly basis. And that equates to $333.33 per month. Now, I will advise you to always go with a syndication that pays as quickly as possible, right? So if it can pay monthly, like if you had 2 different investments, one that was offering 8%, right, annual preferred return, but it paid quarterly versus monthly, I would always tell you to go with the one that pays monthly, right? Because what you can then do is you can take that money and invest it into a platform like Peer Street, right? You can invest it into a platform like Peer Street, right? And one of the things that you should know is that money should be working every day. For example, go and look at your credit card. Your credit card has a daily interest rate, right? You want to be on that side of the equation where they are compounding your money on a daily basis, right? So you want to be on the side where if you can take that $333.33 on a monthly basis and put it to work for you, I say do that all day, every day, right? So if you have two different properties, go with the one that pays faster because you can also put that money back to work for you. So how do we start this? We take $50,000, we put it into a deal that has a preferred return at 8%. That's going to generate $4,000 in year number one, right? Now we move on to year two, right? So every year, the property is going to generate a K1, right? And a K1 is a tax document that reports all of the rents and depreciation against that asset, right? The reason why I like K1s is because in the first several years of a deal, that K1 is going to show a loss, right? That K1 is going to show a loss, right? But as I told you just a moment ago, you will have received monthly or quarterly cash flow distributions. Why is that? That is because with a multifamily asset, you're able to do something called cost segregation. I repeat, cost segregation. And cost segregation says that basically we've taken that asset and we're putting it on the depreciation schedule for everything. There's going to be a 5-year, a 10-year, and a 15-year schedule that you're depreciating everything. That's another reason why I in particular like multifamily versus single family, because it's not cost, it's not a real good value to do a cost segregation on a single family house. You're not going to get the returns that you're looking for on a single family house, right? So here we have it. You have the K1. The K1 is going to be showing a loss, right? However, you receive the cash flows from the property, which is actual money into your account that you can then go and invest again, right? So we're going to take another $50,000, right? Because what we're doing is we're taking out discretionary income, right? And we're going to invest in year two another $50,000, right? And that $50,000 is again going to get an 8% return, which is going to be $4,000 per year or $333.33 per month, right? At the end of year two, we would have received $8,000 in cash flows, right? $4,000 times two properties, right? And that $8,000, if you follow what I'm saying about investing it into a crowdfunding platform, right? You would have gotten even more monies on that return, but I'm trying to keep things simple, right? You try to keep things simple because they get complicated all on their own, right? So here you have it, $8,000 that is sitting inside of an account that you didn't have to use these hands for. That's the power of investing in real estate syndication. That's the power of investing in anything that's passive, to be perfectly honest with you. But the vehicle that we are using today is real estate syndications. All right. Moving on to year three, right? April timeframe, I would say you're supposed to have your K1s no later than March, right? But, you know, different operators have different issues that they work through with their accountants. But in year three, you will have received 2 K1s, right? And as I mentioned, the first couple of years in the value add syndications, because we're going to be dumping a lot of money into these properties, right? So that we're going to dump a lot of money into these properties so that we can raise the rents, right? We raise the rents, we take a property that is in a market and not generating market rents. We do a renovation on the unit, and then we can charge an increased rent, right? So here you have the 2 negative K1s, right? The two K1s that you will have received that will show losses, but you have $8,000 in the bank that you could be using for whatever you want, right? Then in year three, right, you saved up, you have another $50,000 that you can invest in the third syndication at this point in time. That's going to be property C, right? So now you have three investments all working on different assets. Each one is generating $333.33 per month, right? At the end of year three, if you had done nothing else, right? If you had just left that money in an account, it will have generated $12,000, right? Again, all of that $12,000 is not going to be from your hard work. You didn't have to wake up in the morning and drive anywhere to secure that money. It's where your money is now working for you because you've already worked hard for your money, right? Combined, give or take, you'll be a couple cents short of $1,000, right? But $1,000 coming into your account on a monthly basis isn't nothing to frown at. I can get very happy with $1,000 a month. I would say, because you are on a 7 to 10 year plan, right? Let me just pause a little bit because some people might get excited and say, well, oh, if I were to have $1,000 a month, that can cover a car payment, right? And I call a car payment a personal asset. A personal asset is anything that gives me certain joys, right? But most personal assets are depreciating in value, right? They don't grow in value. Even if it's a vehicle, you got to wait for the vehicle to become 25, 30, 40 years old before it starts increasing in value, right? So I don't consider a personal asset similar to a financial asset, right? But I would say if you want to invest as we are with Value Investment Partners, you would put that money to work on a monthly basis. Forget it. I can drive a 6-year-old vehicle because that doesn't really matter so much to me. Apologies for the sidebar, but I just wanted to help you know, well, there's $1,000 per month here. What can you be doing with it? You can be investing it again. All right, let's move on to year 4. Now, the slides are getting a little bit busy, right? But what we wanted to do was try to keep this as simple as we can, right? So again, in April of year 4, you're going to receive 3 K1s, right? 3 K1s, right? Each of those K1s at this point in time, maybe the first property is going to be stabilized. You don't know, right? That's why you can't paint a perfect scenario here. But what you can say is that, all right, you're going to receive 3 K1s. Now, guess what? I invested in my first property in 2017, 2018, right? In 2021, one of those properties sold, right? And here we have it, right? A property sells, property A is going to sell, right? You get the $50,000 that you invested in that syndication back, right? Plus, because you participated in a class that allowed you to participate in the upside, that $50,000 is going to come back with an extra 25, right? So now you're sitting on $75,000, right? So you've already made $4,000 a year. So you have that $12,000 plus the $25,000, which at this point in time, right, in year 4, you're sitting on $37,000. But if you invest the way that Lee Johnson invests, you would have put that into a platform such as Peer Street, right? And they would have given you a little bit more interest on that money. So at this point in time, that $37,000 might be 36, might be 38, 39, maybe even $40,000 depending upon the different investments that you were able to strike in, right? So now you have this money that's sitting there, right? Now, guess what? You could invest again, right? Because syndications are happening all the time. You can invest in property D using the $50,000 that you saved for year 4, right? Plus the proceeds that you have from property A. Now that's going to total $125,000, right? And now we are looking at a preferred return of 8% on that $125,000. You guys get where I'm going with this, because this is not by far rocket science, right? Nothing that I said to you today is something that you would have to do that doesn't require a simple calculator, right? There's no calculus, right? There's no differential equations, right? There's nothing else here besides probably addition and multiplication, right? So here we're going to go. That $125,000 is invested at 8%, right? That's going to yield to you about $10,000 per year, or $833.33 per month, right? That's going to be proceeding to you because now you sold off property A, but you still have property B and property C that are yielding you monthly cash flows, right? And now you have the 833 that's coming in from reinvesting those monies, right? So that's going to be yielding you about $15,000 per month, right? $15,000 per month that now you can take those proceeds and you can go and invest that in another, well, you can take that back to Pier Street, as I said, right? You can take that back to Pier Street, as I said, and you can invest it all over again into an interest-bearing loan. You're not going to be able to participate in the upside, but you do know that you're in first trust position. And what that does is that helps you to minimize the risk that you are exposed to, because you got to remember, one of the things that we teach here at Value Investment Partners is preservation of capital is tantamount to everything. If you lose your capital, you are out of the game. You're on the sidelines, you're on the bench, you can't participate. So we have to make sure that we're preserving our capital. All right, moving on to year 5. In year 5, guess what? We're going to have our K1s coming in because property A is already sold. We've gotten that money back, but we're still receiving our K1s for properties B, C, and D, right? And similar fashion to what happened with property A, property B sells. Now, guys, I'm just painting here a scenario. It's probably not going to happen like this, right? In 2020, we had one property sell, right? In 2021, we had 3 properties sell. So it's going to average out, right? But what you can do at this point in time, because now you have the $50,000 that you've been saving, you basically said to yourself, I don't need that extra Starbucks, right? I'm going to put this money to work for me so that I can escape the rat race, right? And then you have the $25,000 proceeds that you receive back from that as well. And remember, that's at a 1.5 equity multiple, right? Sometimes we've been striking out at like 2.5, et cetera, equity multiple. We're just using 1.5 here as a safe example. We don't want to exaggerate it too much, right? But you get to invest in property E with the $50,000, right? For year 5, plus returns from property B, and at an 8% preferred return, that again equates to $10,000 per year. But when you look at your bank, you are now bringing in nearly $2,000 per month, right? $2,000 per month that you didn't have to use these hands, all right, in order to work for, right? And for the most part, as you think about this, right, the same thing that I'm telling you about from year 4, because now you have the flywheel going, right? And I don't know if you guys know anything about the concept of a flywheel, but a flywheel is very difficult to get going. But once the flywheel has the momentum, that kinetic energy is keeping it going. And I hope that you guys are starting to see that here, right? Because in year 6, property C is going to sell, but you have D and E that are there, and you're going to invest in property F, right? And the same thing is going to happen. You're going to take that 125,000 and you're going to invest it at 8% preferred return, which is going to generate you a monthly cash flow. But now that you have all of these properties working together, that cash flow is going to be about $2,500 per month, right? Lee Johnson says, take that $2,500 a month and invest it again and build up more returns so that you can come back into the game, right? So that's going to be year 6. Then in year 6, right, you have nearly $375,000, right, that is invested in getting cash flow distributions that total about $2,500 a month or $30,000 a year. You keep investing the $50,000 and your returns all the way up through year 10, right? Right. So the way that we see this is like you basically have taken and creating a carbon copy of yourself, right? Because that carbon copy is now out there earning money and bringing it into your bank, your coffers, right? And you are building a certain amount of wealth, right? And I think that that makes all the sense. This year, right, when we had the capital gain from the property that sold in 2020, we were able to offset those capital gains with our losses that we received in the first couple of years, right? So basically, we got, I'm not going to say free money, but what we did is we used the investment strategies that have been preached by Robert Kiyosaki, Tom Wheelwright for many years to move into this level, right? So, you know, no rocket science here, just a lot of good talk that we're talking about. All right, there. So that's where we are in year 6. We're going to rinse and repeat the same thing. Year 7 through 10, syndication deals are sold, right? The returns roll into the next investment. And by the end of year 10, you have over $880,000 invested in multiple real estate syndications, right? Literally, if you had taken the example that I had mentioned, that $880,000 should be close to $900,000. And if everything has gone well, sometimes things do, sometimes things don't go 100% the way that you had forecasted it, but you can nearly be close to $1 million in capital, right? And that's your net worth, and that's your financial independence number. I know a lot of people, if they can get a yield of 4 to 5% per year on $1 million, that covers their annual expenses. I want you guys to hear me. If you have a net worth of $1 million, that can cover your monthly and your annual expenses. And that's where life becomes a whole different thing, because at this point in time, you're producing about $70,500 in diversified passive income. And I'm going to have a quick tangent here, but you have to read and know that there are different forms of income, right? And the different forms of income are taxed at different levels. I would say this to you, capital gains maxes out at 20%, whereas earned income today maxes out at 37%, but the 2017 tax laws expire, portions of it expire in 2025. And I believe before it went there, it was around 40 to 42%, right? So one of the things that I stress to you all is ensure that it's not really about how much money you make. It took me a while to learn that. It's about how much money you can keep, right? That's the critical piece of this, right? So it's about the amount of money you can keep. So we explained it here, right? There's no rocket science in what we are teaching here. But what we are teaching here is a strategy that when you exercise these strategies with a bit of discipline, right, in literally 7 to 10 years, depending upon how things are working out, you have secured financial independence. And, you know, I'm not a huge fan of the FIRE methodology, right? Because me personally, I don't want to retire early, but I like the financial independence portion of it, right? So let's summarize this, right? If you are investing $50,000 each year for 10 years, the result of that, right, generates about $70,000 a year in passive income, right? Remember, right, life in and of itself will always give you a twist and a turn, right? So it's not going to be clear cut as this, but I guess that there would be a plus minus on this one as far as how it would work, right? And as we mentioned now, the market is such that at 8% preferred return today, right, is a little bit difficult to get, but it was that way 2 years ago, right? So not all deals generate an 8% preferred return. Right now, you're typically going to be at 6, 6.5, et cetera, right? The whole time on a real estate syndication is typically about 5 years, but you know, with the pandemic, et cetera, we've been exiting deals at 3, 4, and 5. As I mentioned, the one that I invested in 2017 is selling right now, right? We're probably looking at a 2.2, 2.3 equity multiple on that deal, right? So the examples that we shared is about investing monthly, quarterly cash flows, right? The good idea for us is that you reinvest those monies, right? And I don't know if you guys have heard of the infinite banking concept, but if you haven't heard of the infinite banking concept, this is something that we are now practitioners of, and we can share what we have learned about setting up our own banks. Literally everyone in our household has an insurance policy, and we're leveraging those insurance policies whenever we have a financing need, right? And last but not least, always remember it's not how much money you make, right? It's how much money you keep. When you are an earned income employee, right? Uncle Sam is a significant beneficiary in your earnings because the government, in many different ways, regardless of where you are, the federal government, right, is going to tax that at about, let's just say 30 to 33%, right? With all the deductions and things of that sort, you might tap out at about 30% of your take-home pay is going to be dedicated to paying taxes. So always remember that Uncle Sam is going to be around there. I had a conversation with a colleague earlier today, and we were talking about athletes who get these max contracts of $200 million. The only person who's just as happy as the athlete who's signing the contract is Uncle Sam, because he's going to take a significant portion of that. Well, there's another person who's happy about that contract, and that's the team owner So if you ever have any ambitions to own a sports team, you're going to be in a pretty good position because that salary for that athlete is now an expense to you. All right, so that's what we have, right? So hopefully you got the summary, right? Set your goals and your criteria, review every opportunity, act. Usually these deals are on a first come, first served basis, but you got the formula now, you got the recipe, you have the ingredients. It's time to go bake that cake, right? Don't talk about it, right? You have to take action. Otherwise, all of this wasn't worth it. Closing out, if you scan that QR code, it gives you all of our details, and this is how you get in touch with us. You can either schedule time on our calendar, or you can text meetup to 571-444-8474, and we'll get back to you. Either I will get back to you directly, or Eunice, who's my wife, will get back in touch with you as to any questions or concerns that you may have. And last but not least, if you are in the Northern Virginia area, we have a networking event, and that networking event is the next one is going to be on November 12th, right? We meet at the Ridgetop Coffee and Tea. And as many of you have already come there, it's a session where we talk about all things real estate, whether or not if it's going to be fix and flip, hard money lending, whatever you want to talk about from a real estate perspective. It's really just bring your card or bring your LinkedIn code, right? So that you can scan it and start networking with others. And then we'll have our next meetup on the educational side, right? Where we're going to be bringing that forward because, we typically meet on the fourth Saturday of the month, right? We're bringing that forward because that's going to be the Thanksgiving holiday, and we don't want to interrupt anyone's festivities as well. So I want to thank you for coming out this afternoon and spending time with me. I wanted to make sure that I was succinct, right? And I wanted to make sure that I got you out of here within 1 hour's time. So I want to thank you again because I'm so gracious for you spending time with me. I'll open it up to any questions or concerns that you may have. I'm happy to stay on for as long as it takes to address all of your concerns. And thank you again. Anyone have any questions?
Yeah, I did.
All right, go ahead.
So you said that we can get cash value out of our life insurance policies. What would that process be like? Just calling our life insurance policy holders and asking them about taking cash out?
I would say negative, right? If you were to go and to call someone at State Farm or Prudential, right, they're going to probably set you up with a life insurance policy that doesn't generate as much cash value early on, right? We're not, of course, we're buying the insurance because we want to have access to the death benefit, right? We're human beings. Everybody is eventually going to pass on. However, the reason why we're using this as an investment vehicle is so that we can get access to the cash value. And if you work with an insurance broker who is not familiar with the infinite banking concepts, right, they will give you a product that will draw on the death benefit more so than the cash value. So if you wanted to have more conversations about how this infinite banking thing works, we're practitioners in it. We can help you to understand the nuances and work with you to, run you a quote, et cetera, because we're doing it ourselves, right? So if you need any help with that, Christian, just, use the details that I shared with you, and we'll be able to give you that information.
Okay.
Does that work? Does that work?
Oh, yeah. I'm sorry. Yes. So that's the same if you already have life insurance policies too? That's why I was asking that, because I already have 2 life insurance policies.
Well, what we would have to do is we would have to look at your different life insurance policies, right? We would have to look at your different life insurance policies to do an analysis to determine how it has been structured. Okay. Right? You can go in and look at your life insurance policy to see if it's having any cash value to it. But if you have a term, if most likely if you have a term policy, it's not generating any cash value,
Okay.
right? It's not going to be generating any cash value at all. But basically, what that policy is doing is covering your risk in case you should pass on your family. You know, you're an earner for the family, right? So without you, that money stops coming in, right? But what this allows you to do is this allows you to protect or de-risk your family in the event that you should pass on or become disabled. That's why I don't call it an insurance policy. I call it risk mitigation, because that's
Okay.
what you're doing by deploying these policies. And I just put the link that I have for Peer Street into the chat. And when it comes to Peer Street, I've been investing in Peer Street probably since 2016. Now I'm going to be honest with you. When the pandemic did happen, we ran into some issues where a lot of foreclosures were happening, right? What I would tell you is if you're going to invest in the Pure Street, what you want to do is you want to invest in non-judicial states, right? There's judicial states where if you want to foreclose on a property, you have to take them to court. With a non-judicial state, if you want to foreclose, you just take it to the sheriff and say that they didn't exercise on their note. A constable will come out and you would file it from there. So a judicial state can take months, if not years, in order for you to foreclose. With a non-judicial state, it can be weeks, if not months. So that's the real difference that you have there. Make sense?
Yes. Thank you.
My pleasure. Hopefully you found value in the conversation today. Can I ask a favor, everyone? I wanted to take a picture and share it on social media because, I'm just trying to grow this meetup. If you don't mind, could everyone besides Joe, because Joe has the dog that's, at the computer. And every time we talk, I'm like, how did you get that dog to set up like that? But if you could, I wanted to take a quick picture and share it on social media, if you don't mind.
So I can keep the dog on.
I love the dog. I love the dog and I love the picture. But hey, if you guys don't want to come on, then they'll just have to look at my face. All right. Cool. Anybody have any other question? Hey, Edward, thank you for coming, and I appreciate you taking such great notes the last time. And no questions?
I did have one more question.
All right.
So you were talking about capital gains that you would have to pay when an asset is sold. Is that the syndication overall or you specifically? Because I wanted to know, could you use a 1031 exchange to kind of get around that?
The thing about a 1031 exchange is that it's always like for like, right? So when you're investing in the syndication, right, they may give you the option to do a 1031, right?
Okay.
If you do a 1031, then you don't have to worry about any capital gains until they sell the next asset, right? But the strategy that's there, Christian, is I call that strategy swap until you drop, right? Swap until you drop, because if you're doing 1031 until you die, there's no capital gains that you're worried about. Your estate has to worry about that. But then there's all kinds of tax basis issues that come along with that, right? So that's a whole nother deep conversation. But if the syndication, when they're selling the asset, allows for you to participate in the 1031, then you don't have to worry about capital gains at that event, right? Those capital gains and losses, all of that will accrue until you finally sell the asset.
Okay.
So yeah, 1031s, I call it swap until you drop, and it's a great strategy as a whole. It's a beautiful thing. And now, you know, this is all legal, right? None of this is illegal. All of this is legal. The government actually wants you to do all of this. So I say, if the government is saying to you, this is what we want you to do, you would be remiss not to do it, right? You would be remiss not to do it. So I say, if the government is going to give you free money, take it all day, every day.
Exactly. Thank you.
My pleasure. All right. Anyone else?
Hey, Lee, I have a quick question.
How are you?
I'm doing pretty good.
Why you didn't want everybody to see your face?
I'm looking not the best right now.
Oh,
But
you
I'll
didn't
show
get all
you the next
dolled
one.
up. You didn't get dolled up. All right. How are you?
I'm fine. I just came from a workout before the call, so
No.
that's
Hey,
why.
thumbs up for getting your exercise in on a Saturday.
But my question was around the Peer Street platform and the crowdfunding. So you mentioned, let me see the question here. So when there's multiple investors with crowdfunding, you mentioned the first trust position. How does that work with multiple investors?
No,
Is everybody kind of getting that first trust position, or how does that work?
everybody's in first trust position. It's something called pari passu, right? Let me bring it up. So you can look it up all on your own, but I just found it, and I'm going to share the screen here. So pari passu is Latin, meaning equal footing. This describes situations where two or more assets, securities, creditors, or obligations are equally managed without any display of preference, right? So that's what pari passu is. And pari passu actually allows you, right, allows you to be in the first trust position with everyone else. And that way, that way, when it comes time to, there's a foreclosure, right? You don't have to worry about being in second or third trust position. You're in first trust position, and you are able to win.
Gotcha. Okay, thank you.
Pari passu is the best thing, and you know, probably 2014, 2015, 2016, I was a hard money lender in Northern Virginia, but in Northern Virginia, the average property in Northern Virginia is about 500,000, probably 450 to 500,000. So if you're loaning money on that, you have to have $300,000-400,000 to get into a first trust position, right? But I was doing like friends loans, right? Guys who were doing flips, I would loan them $50,000, but we didn't record that at the county, right? It was just really a friends and family type of conversation. But I don't know about you, but when it comes to $50,000, I should not have been investing that way, right? And then there was a one or two deals that went a different way, and you not only have the potential to lose money, but you have the potential to lose friendships. So I would say, unless you can get into first trust position, you never want to be doing hard money loans. I hope that helps.
Gotcha. Yep, it did. Thank you.
My pleasure. All right. Anyone else with a question? Otherwise, I hope to see you at the next rodeo. All right. But I want to again thank you for spending part of your afternoon with me. I hope the content was valuable and you have an idea as to how real estate syndications work, and that it is a vehicle that can be used by anyone to continue to grow their wealth. And as well, you stick around with Value Investment Partners. We beta test all of this on ourselves, right? In our family. And we have insurance policies. We're investing in so many syndications, as you can see on our website. And we're constantly bringing new, I would call it, well, one of the books that I read, Debt Millionaire, he calls it debt weapons. These are weapons that we're using to grow our wealth. So we're sharing that with you and hoping that you come along for the ride with us. So going once, going twice, no other questions. If you want to find me, you have my Calendly link, or you can reach us at valueinvestmentpartners.com, or you can text us or call us at 571-444-8474, and we're happy to have a conversation, or we'll meet you for coffee the next time we're around. All right, great. Have a great one. Enjoy the rest of your Saturday. Stay well, and we'll talk soon. Bye-bye.